Good afternoon, everyone. This is Edward Talisse for Chelsea Global Advisors and the CQF Institute. It's the 12th of December, 2014. Last week, we talked about how it seemed the expectation in the marketplace, and indeed my own expectation, was for a fairly quiet crawl into the end of the year where headline indices in U.S. equities and some of the other indices, particularly in Japan, would close out the year showing fairly decent year-to-date returns, around 10%. And bond markets continued. Our belief was bond markets would pretty much stabilize at current levels and close out the year fairly quietly. However, since then, within a short course of a week, volatility has seemed to return to the market, and it's all led by oil and the fallout of oil, which we're going to talk about in a couple of minutes. So volatility has returned, although the VIX index and some of the other indicators of market stress and market fatigue have really not reached levels that we saw in the middle of October. But indeed, the headline indices are definitely taking a step back. So it seems it's going to be an interesting couple of weeks when most people are on holidays and trading activity tends to decline into the year end, and where a lot of managers of investment funds, are hoping to book profits and close out the year a little quietly. So the next couple of weeks will be interesting, and myself, we're hopeful that we're going to do another video cast next week, so we could, close out the year a little closer. I think the most interesting thing about the current price action in the market is that it highlights three things about finance, and more particularly three things about trading and trying to make money in finance. First is that the fallout from the significant drop in oil was completely unanticipated and unexpected in pretty much all quarters, from leading experts in the oil field to casual investors to very sophisticated professional money managers. So it just goes to show that regardless of how much research and preparation you do, it's very difficult to predict the uncertainty that's going to happen in any market. It's certainly difficult to predict the timing of that uncertainty. Second, the other interesting thing that I myself quite enjoy is, if you think about oil was last around $60 a barrel, and I'm using Brent oil as sort of the benchmark here. It was around $60 in around 2007. So it took 7 years for it to move up to around 110, 120 a barrel, and it took about 5 weeks or so to move down. So as we've talked about this many times, that the upside tends to be slow and grinding, and it means it's very difficult for investors to have patience when markets are trading sideways to slightly up, whereas all the action and all the fun seems to be on the downside. But again, it's very, very hard to catch the timing on the downside. The third thing that I find very interesting about the oil fallout is that, for a very rare instance, this is one time where money is actually transferred from large corporations and Wall Street traders and bankers actually to regular people that have bills to pay and presents to buy for the holidays. And it's quite enjoyable to see that the consumers, or most consumers, should enjoy a very robust boost of their spending power between now and into the holiday season, as oil prices fall, which means it costs a lot less to fill up your tank of gas, and there's more disposable income at your behest. So those three things I find very interesting. What I thought I'd do right now is just talk a little bit about the fallout from the oil prices and who are the winners and who are the losers. And on this chart, I really just chose to talk about the losers. The winners are clearly companies that benefit from increased disposable income, companies like maybe Walmart or Target, and some of the consumer discretionary companies. But the losers here, I don't necessarily claim that any of this is original, but I do think some of it is interesting and not at all intuitive. But firstly, some of the currencies of the major oil-producing countries, such as Norway, Russia, and Venezuela, they've all taken significant hits to their currencies. The currency, obviously, in these three countries are based upon large export earnings from moving barrels of oil out of their countries at around $100 a barrel, and now that those barrels of oil are priced closer to $60, obviously those currencies will take a bit of a hit. Second, the major oil producers, I consider Exxon, Chevron, BP, Shell, and Conoco. And these are also the major producers that are involved in the shale oil revolution that's been going on that has really contributed to such excess in supply. But these companies obviously will take a hit simply because the price of their main products is going down and going down quite significantly. The interesting thing about the major producers, at least over the near term, it's very difficult to assess the impact on their earnings of these companies simply because they all are major users of derivatives, and it's likely that some, if not all, of current production and parts of forward production have been sold in the derivatives market. It probably prices much higher than what we're seeing the spot prices today. So it's very difficult in the short term to assess the impact here. Clearly, as capital spending goes down, because the upside of digging for oil and exploring for oil is not what it was just a short time ago. The oil service companies such as ABB, Schlumberger, Halliburton, Baker Hughes should suffer because these companies up here just don't have the capacity anymore to spend as much on capital spending as they did. So you would expect these companies to be hurt somewhat, and in fact they are. More interestingly, I think there are a number of banks that have large exposures to the energy sector. This is public information. You can go into their public filings and see that companies such as JP and Citibank have unsecured loans to the large energy producers and oil service companies, and indeed to some of these countries. JP's exposure, I saw some research that both JP and Citi had exposures around $50 billion, and BOA maybe something half of that. Default rates on these loans historically for the last couple of years have been very low, but it's reasonable to assume that the default rates will move up something from the low experience that we've had over the past couple of years. An asset class that I personally like has been taken a bit of a hit recently. There are some high yield ETFs and mutual funds that have large concentrations in bonds that are owned, that have been issued by energy companies, such as the ETFs that are indicated by the ticker HYG and GNK. So high yield as an asset class, although in today's very low interest rate environment, to me looks very attractive, has really not experienced any sort of rebound because of the exposure to the energy sector. And lastly, I thought I would talk about some of these renewable energy companies. I think there's a mixed track record here over the last couple of years, but there are some big companies that have businesses that are highly exposed to renewable energies. I just mentioned three of them here. Iberdrola, which is a Spanish company that has a very strong business in steam energy. Calpine, which is obviously in California. They use and rely on some of these non-carbon geysers that you experience or that you see in the western part of the United States. And Siemens, which is a big world company as well, that has a very big and powerful wind energy business. So looking ahead, it's going to be interesting to see how the fallout of energy continues into the end of this year and, more importantly, into 2015 and 2016. Please look at Chelsea Global Advisors' website and the website for the CQF Institute, and hopefully we'll talk again next week. Thank you very much.